Hello, my name is Robert. Welcome to TRDR.tv. Today we're going to be doing an episode of Stock Market Trading 101. Today's the first episode, so prepare yourselves to be entertained. So first of all, one of my first tips is make sure when you're starting with trading on the stock market that you start with money that you have the ability to lose. Of course, when you're first beginning, you have very little experience except for what you learn on broadcasts like this or other YouTube channels, and so you need to give yourself some wiggle room, basically, in case something does happen, in case you make a wrong choice, in case something really unexpected just happens, in case there's a crash in the stock market, whatever. You need to make sure that when you begin, and really even when you're a more experienced trader as well, that you trade with money that you have the ability to lose, 100% of it. So that's my first tip, just to start with. And then the second thing, obviously, is you need a computer and internet access, because most of these days people do their online stock trading with an internet broker. So it's important that you obviously have a computer and internet access in order to not only trade over the internet, but also to get your information and do your research. So one of the things that when it comes to choosing an internet broker is it really depends kind of, I guess, what sort of trading you really like to do. For example, if you like to use a lot of charts, I know that there's, for example, E-Trade Pro that I believe has good chart making abilities compared to some of the other internet brokers. But it really just depends kind of on your style, I guess. So you need to do a little bit of research for that as well before you really get committed with one single company. So a couple options for you for internet brokers is Ameritrade, Charles Schwab, Scottrade, and then E-Trade. And so I know they have E-Trade, I think E-Trade Regular, and then E-Trade Pro if you want to upgrade to that for chart making abilities. One of the things you also need to look out for is when you're choosing a company, you need to make sure that it has usually a cost of like $12 or less per trade. So that means that every time you trade, every time you buy or sell a stock, it's going to charge you $12. So that's probably like the maximum. Like I said, it just depends on your particular trading style. Some of the other ones are less, I think around like $5 or $8 or $10. So it just depends on your style. So the first real most important tip that I'm gonna express myself, or that you'll hear from me and from other people as well who make YouTube or other sorts of informational, educational videos, is that you need to do your due diligence. You need to make sure that you've done a good amount of research before investing in a company. So it's almost the exact same thing as choosing an internet broker. You need to do a little bit of research, because these are going to be very important decisions, and you're basically, you're gambling your money almost on these decisions that you're making. So it's definitely very, very important that you do your DD or your due diligence before you invest in a certain company, or before you decide to invest in an ETF or an index. And so there's a couple different ways that you can do some research. Obviously, is through the internet. You want to look for reliable sources. I like to use Bloomberg or Google Finance. But there's also other applications you can use. You can use certain stock market trading forums, but you need to be a little bit more careful on some of these forums, because there's a lot of people who prey on the weak, I guess, or prey on people who are looking for reliable information. So there's, for example, there's a type of people who are on like the forums or on some of maybe the social media websites that are called it's called a pump and dump. Basically, what they do is they buy a huge share, or maybe a small share, or just they buy a couple shares of a stock, and then what they'll do is they use their following. Say, for example, on Twitter, they say Google is going to go up because they put out a new iPhone, or that's just an example. And then as soon as all of the followers have bought a couple shares, and the original pumper, the person who said that who has the followers, said that the stock is going to go up. After it goes up a little bit, he will sell all of his shares. So he just made a little bit of money, and now you, as a person who's following this person on Twitter, is now stuck holding a bunch of cheaper shares. So you've lost a fair amount of money. This is one of the reasons why I think TRDR.tv is so good, because you actually have the ability to see kind of into their past predictions and forecasts, to see what they've done, and you have the ability to kind of to screen out some of the people that may be doing this. And also, I mean, you can kind of see on the leaderboards also who has different success, who has the most success, and then obviously from there you can go into the recommendations and see the actual timing of the recommendations, and when they bought and when they sold, and yada yada yada. So I think it's a very important tool for people who want to start trading. Another tip that I'm gonna say for beginners is just a little bit of an explanation, kind of, I guess, about how internet brokers actually work and how you can kind of trade using certain abilities. So let's just get started. For the first thing that I want to talk about is the ask price versus bid price. So there's usually a little bit of a range in between the ask price and bid price, but it depends really on the share price of the stock, depending on how much is going to be the margin between those. The ask price is the price that the internet broker is asking for buy. So if you want to buy the stock, you have to bid for it or buy it at the asking price. If you want to then sell the stock, you have to sell it at the bid price. So say, for example, you buy a share of Apple, and the ask price is $500. It's likely that the sell price is probably going to be like $499.75 or something like that. The range is usually not too drastic unless you're trading on penny stocks. But that just gives you an example that if, say, for example, you bought it and then you literally sold it 1 second later, you would already have lost a little bit of money. So you need to make sure that when you're doing your first couple trades, that you're looking out for the different ask/bid prices, just so that doesn't kind of confuse you up. So you don't think that you're selling it at the ask price or buying it at the bid price. The second thing that I want to say is the different types of orders that you can do on internet brokers. So the first one is going to be a market order, which basically allows you to specify a certain quantity of stocks that you want to buy. So this is just the normal fashion, or the normal way of purchasing stocks. But if, for example, you're trading in penny stocks or highly volatile stocks, then you need to maybe use limit orders, because that actually specifies a certain price and quantity at the same time. So in case, for example, you're trading penny stocks, you're investing in you want to buy a couple thousand shares of a stock that costs 5 cents per share, and then so you're trying to buy the stock, and right before you buy it, it somehow jumps up to 10 cents a share. So now the price of with your original order has now doubled. If you just use a market order, that is still going to go through. So you just pay double for the stocks that you wanted to buy. But if you use a limit order, it actually puts a limit on the price. So if that jump does really happen at the last second, the actual order won't go through. So that's just kind of a useful thing to help you when you're first starting. And then after that, say for example, if you are you're busy, you work all the time, or you just don't have the ability to always be watching the stock market in case the prices go up, prices go down. One of the things that you can do is you can place a limit sell order. So basically what that's going to do is you can set a certain percentage or level that you want to actually sell the stock at. So you don't even have to be at the computer in order for the sell to go through. So say, for example, we'll also go back to our original example, Apple, and so you buy it at 500 and you're worried that it's going to go down a little bit. So what you do is you can actually set it so that if the price goes down 15%, it'll sell it automatically. And you can also do it the other way as well. So you can make it so that if it goes up 15% and you want to just lock in those gains that you just made, you can make it so that it automatically sells it if it goes up 15% from your original buying point. One of the things you do need to be careful about is hedge funds. I believe they have the ability to actually see if there's large blocks of limit sell orders. So it's not really a very big deal if you're just starting out, if you're just trading a couple hundred or a couple $1,000s. But once you start getting into the tens of thousands and hundreds of thousands of dollars, I mean, from what I hear, that hedge funds actually will intentionally drop the price down to certain levels where they have huge blocks of sell orders in order to get those shares to come onto the market so they can buy them at a cheaper price, kind of. So that's one of the things that you need to be careful for, to watch out for. One of the other tips I'd like to share is basically that if you're not sure if what you want to do, like say for example you invested in the stock and it went up 10-15%, and you're not sure if it's going to keep going up or if it's going to drop down, you're just a little bit worried about what to do with your stock that you just made a little bit of money on. One of the things I recommend is that you sell half. So if you sell half of your stocks, that way you lock in that gain, and at the same time, if something bad happens, you can, if it starts to drop down a little bit, you can sell the other half. Or if it goes up a little bit, you can sell the other half. But that way, you've at least locked in half of your earnings there. So that's a little tip. The last piece of advice that I want to give is something that I originally read on one of the forums. So at first, I was of course a little bit wary about it because you never know anything about the actual people that are posting on forums. But after a couple of years, I realized that it was actually really good advice, and that is, basically, if you feel like a stock genius, if all of your stock choices that you've made have gone up and you're making good amounts of money and you feel like a king, it's probably the time to sell your shares. That's, of course, it's not necessarily for every company, but it's for one of the things that I've noticed is at least sell like half of them, like I was saying before, because it's usually at that point where it's something that may happen. Like there may be, it may fall backwards for a little bit before it's going to go back up, or it's basically just very important to lock in those gains once you have them, so that, because if it drops down and you're not there to buy or to sell or to do whatever you're going to do, you're going to kick yourself, and it's really gonna hurt your percentages. The other half of that is, if a stock is causing investors horrible disgust, if the actual investors themselves are ranting and raving on the forums, or just really hating the company, it's probably a good time to buy. That's just, for example, recently there was the thing with Chipotle, for example. I think they had an E. coli outbreak or something like that. These are kind of things that always go away. And so you can see that the stock has already improved since then. Another example is British Petroleum, when it was a couple of years ago, I think 2008 or 2009, I'm not sure. But they had the huge oil spill in the Gulf of Mexico, and I think the stock prices dropped 15-20%. But they recovered after that. And so that's just a good example of when it's usually a good idea to buy. So you don't even have to get that full 20%. Even if you just get the 10% gain over 3 or 4 months, that's really good. I mean, that's a healthy percentage. 10% is a really good amount that you should expect from trading safely. And so that's basically my best piece of advice, because it gives you an example of when you should really be looking to buy or to sell into stocks. So that's all we have for today. Thank you very much for joining me. Please check out TRDR.tv, and I look forward to doing another show next week.